Welcome to the Billboard Mastery Podcast, where you will learn the correct way to identify, evaluate, negotiate, perform due diligence on, select the construction type, build, rent the ad space, and operate billboard signs. And now, here is your host, the guy that built from scratch the largest privately owned billboard company in Dallas-Fort Worth, Frank Rolfe.
On February 9th, 2026, it was announced that Clear Channel, which has 61,000 billboards in 81 markets, was going to be acquired by Mubadala Capital, an Abu Dhabi sovereign nation wealth fund, for $6.2 billion, which worked out to $2.43 a share. And if this deal should actually close, it will close in the third quarter of this year. And at that time, the stock will be permanently delisted from the stock exchange, as it'll be a private company owned by this Abu Dhabi sovereign nation fund. So what does this mean for the billboard industry? Is this a good thing? Bad thing? What's the impact of that? Well, let's first look at the transaction, because Clear Channel's stock has been a real loser. It went from $31.14 a share in 2007, right before the 2007-2008 Great Recession. And it fell all the way down to under $2 in recent times. So if you'd bought a share of this and held that thing for 20 straight years, you would have received only 10 cents on the dollar of what you paid 20 years earlier. That's a catastrophic return on investment. And so what's happening is, I think that Mubadala Capital thinks they're getting a real bargain. And here's why. Because they're buying Clear Channel at a PE ratio of 12.3. That's the price to earnings ratio is 12.3. But the competition, the Clear Channel, Lamar is trading at a 16.5 price to earnings ratio, and Outfront at a 16.1 price to earnings ratio. So clearly I'm imagining the people at the Abu Dhabi Sovereign Wealth Fund are looking at this saying, well, this thing is hugely undervalued. Has to be, because it's trading at a huge reduction to the other almost similar companies which have a far higher price-to-earnings ratio. And remember that the amount they're paying, $2.43 a share, is a 71% premium to the stock price the day it was announced, which is it was only at $1.42 a share. So what was the deal? Why did they do this? Why now? Well, clearly, number one, I think they thought the stock was undervalued. But it's not undervalued if it's going to be subject to further declines in the market. And I think what they think is that the billboard industry has pretty much hit bottom, that it's now weathered through all of the issues that came with the advent of computer advertising and online presence. And now they want to get their foot in the door because they think it's about to rise. So why would billboards rise? What's going on there? Well, everything we find runs in cycles. So right now, people have just been working and trying to maximize their online presence. But at some point, you get burnout. Too many ads, too much going on. Consumers can't really handle it. But the bigger issue is the fact that billboards have a unique position in the market that really isn't a part of online advertising or its strengths. And that is namely that billboards are point-of-purchase advertising. Online cannot tell you when to exit to get to McDonald's. You're going down the highway, you don't really know what's at the exits or anything about it. And then you see the billboard that says McDonald's next exit. And if you enjoy McDonald's like I do, I like McDonald's for both breakfast and lunch, that's going to tell you, okay, yeah, I need to exit number 38 and move your car on over there to make the exit. Only the billboard could hit you at that precise moment when you were approaching the exit with enough time to get over to get off. And that's very, very unique. You can't do that with any kind of online ad. So I think that is the first big proponent to why billboards are on the rebound, is simply that fact that a billboard can act like a big old direct marketing advertising guy telling people, hey, get off now. Hey, McDonald's is at this exit. Number two, you have more Americans than ever before that are really getting interested in a lot of those old-timey things that billboards have always advertised. Fast food's making a rebound in a costly world where a lot of restaurants, your more mainstream but yet sit-down restaurants, prices have risen to a premium. Fast food restaurants are still eminently affordable. And a lot of the roadside hotels and motels, again, much less expensive than many of the other more high-rise options. So a lot of the things that people buy in America that may have gone a little bit out of favor as Americans became richer are going back into vogue as Americans become poorer. And as a nation, that's all we have is endless problems as far as paying our bills because everything has gone up at such a high level. The average American is strapped. A lot of the things that people who are strapped are going to be looking into are the very things that billboards have long been the favored advertising source for. Remember that the biggest advertiser in America for billboards is, in fact, McDonald's. And we play a perfect part of not only their reach to the existing customers, but also the timing of when they reach those customers who are in need of buying food and telling them that now is the time to exit. Now, will this be a successful transaction? None of us really know because we don't know what the future holds. But I can tell you that private equity groups are pretty good about doing due diligence. So they have done lots of economic models, they have no doubt built, showing them that billboards are now on the ground floor and probably going to go up. And that's why they took this timing, this moment, to make the purchase. They have very, very good confidence in this investment that they're getting in on the ground floor at a bargain basement price and they're going to ride it up. And their feeling of confidence should give most people in the billboard industry a little extra confidence because it's unlikely they would spend such a massive amount of money. They're spending $6.2 billion on this transaction. They would be unlikely to make a commitment of that stature unless they felt very, very strongly that things were about to be on the rebound. This is Frank Roth with the Outdoor Billboard Mastery Podcast. Hope you enjoyed this. Talk to you again soon.
Thank you for listening to the Billboard Mastery Podcast. Be sure to visit us at www.billboardmastery.com, where you can find past episodes of this show, plus an array of information to help you successfully build, buy, and operate billboard signs.